Well, congratulations. We're at the point where we can flip the Form 1040 over onto page 2 and we'll start covering itemized deductions. Itemized deductions are reported on Schedule A. Now, as we've already seen, the Internal Revenue Service allows each taxpayer a standard deduction amount that's based on the taxpayer's filing status. Some individuals, however, find that they can get a better tax break if they itemize their deductions. Itemized deductions allow taxpayers to reduce their taxable income based on certain specific personal expenses. If the total itemized deductions are greater than the amount of the standard deduction, then this will result in a lower taxable income and consequently lower tax. You have to file the 1040 long form in order to use the Schedule A itemized deduction form. Now this means you'll have to keep track of expenses, meeting income thresholds, and satisfying certain deductibility limits. Schedule A generally allows the taxpayer to subtract from income the amount spent on medical care, other taxes, some interest payments, charitable gifts, casualty losses, and several miscellaneous expenses. Here's an example of a Schedule A. In each section, we'll take a peek and break the Schedule A apart like we're doing on the 1040. We'll break it up into its individual sections. First, the medical and dental expenses. Then we have taxes that you paid. Then we have a section for interest that you paid. Next, gifts to charity, casualty and theft losses, job expenses and certain miscellaneous deductions, and finally, other miscellaneous deductions. We total these up and we come up with a figure for total itemized deductions. The total itemized deductions from Schedule A then flow to line 40 of the 2016 1040. Now, like the various adjustments to income that we spoke about in the previous module, itemized deductions provide a way to convert taxable income into non-taxable income, provided money is spent on various tax-privileged items. You can deduct from taxable income any money that's specifically spent on health care, state and local taxes, mortgage interest, charitable donations, and tax preparation fees. Generally, unless the taxpayer is making mortgage payments, has a lot of medical expenses, or donates a lot to charity, he or she will be locked into the standard deduction. If the taxpayer does own a home, makes large donations, or has a lot of medical bills, then he or she will definitely want to take advantage of itemizing deductions on the Schedule A. First, let's take a look at the medical and dental expenses section of the Schedule A. Only the portion of total medical expenses that are greater than 10% of a person's adjusted gross income, or AGI, can be deducted as part of itemized deductions. For example, Tom Swift had adjusted gross income of $38,500 on line 38 of his Form 1040. His total eligible medical expenses totaled $2,850. So let's find out if any of his medical expenses are deductible. Well, his AGI was $38,500. 10% of this figure, $3,850. His total medical expenses were $2,850 minus the 10% of his AGI, $3,850. In his case, none of his medical expenses are deductible. They did not exceed 10% of his adjusted gross income. Generally speaking, a medical expense will qualify for a tax deduction if the expense is for the diagnosis, cure, treatment, or prevention of disease. The following general types of medical expenses will qualify: costs for medical services from physicians, surgeons, dentists, and other medical professionals. The costs for medications that are prescribed by a medical professional. Costs for medical devices, equipment, and supplies that are prescribed by a medical professional, for example, eyeglasses. Costs for health and dental insurance. Costs for long-term care and long-term care insurance. Transportation and lodging costs for traveling to a healthcare facility, including mileage for driving for medical care, is also deductible. For the tax year 2016, the mileage rate was 19 cents per mile. Over-the-counter treatments, nutritional supplements, vitamins, and first aid supplies do not qualify as tax-deductible expenses unless those items are once again prescribed by a medical professional. Controlled substances, such as cocaine and marijuana, are not tax-deductible either, even if they're prescribed. Let's move on to the taxes you paid section of the Schedule A. There are 5 types of deductible non-business taxes: state, local, and foreign income taxes, state, local, and foreign real estate taxes, state and local personal property taxes, state and local sales taxes, and qualified motor vehicle taxes, which are often called ad valorem taxes. If the taxpayer lives in a state that collects state or local income taxes, the amount paid goes on line 5 of the Schedule A. That includes any tax payments that were withheld from a paycheck and shown on the W-2, plus any balance due that was paid on the previous year's state tax return. The following state tax amounts are also deductible: any estimated taxes that were paid to the state or local governments during the year, and any prior year's state or local income tax paid during the year. Property owners can deduct real estate taxes that they paid. You enter the amount on line 6 of the Schedule A. These taxes are charged each year, usually from a county tax assessor. If the taxes are paid by a mortgage company with escrowed funds, you would only deduct the actual amount of taxes paid in the tax year, not the full amount of escrow payments that were sent in to the lender. Some states, counties, and cities impose personal property taxes. The most common of this type of collection is on vehicles. This is not the license plate tag fee. It's a tax that's based on the value of the vehicle, and again, often called ad valorem taxes. Car taxes, as well as other personal property tax bills, are deducted on line 7 of the Schedule A. Line 8 of the Schedule A gives the chance to deduct what the IRS calls any deductible tax that hasn't been listed earlier. A common entry is a deduction for taxes paid to a foreign country or to a U.S. possession. You add the amounts from lines 5 through 8 of the Schedule A. There's no limit or minimum to meet for this section. We enter the full amount of non-federal taxes paid on line 9. The next section of Schedule A, interest you paid, is primarily for the benefit of homeowners. While interest paid on personal loans and credit cards won't help at tax time, interest on home loans, both a primary residence and a second home, is deductible. On line 10, enter the home mortgage interest paid. Generally, This amount is reported on a Form 1098 that comes from the mortgage lender at the end of each January. If the home was purchased last year and points were paid for the loan, those points, typically each point is 1% of the loan amount, will be listed on the 1098 as well, and it should be included on line 10. If mortgage interest paid was not reported on a Form 1098, enter it on line 11 of the Schedule A. This might be the case if an extra house payment was sent late in the year and the lender did not properly credit the additional payment. And if interest was paid to an individual from whom the taxpayer bought the home as a personal sale, this interest is also reported on line 11, along with the seller's name, address, and tax ID number. Any points not listed on the Form 1098 may be found on the settlement statement. Also, if a home improvement loan was taken out that was secured by the house, and part of that loan money was used to improve the residence, then some of the points may be deductible. These non-1098 point amounts go on line 12 of the Schedule A. Still in the interest section of Schedule A, on line 13, we report mortgage insurance premiums, most often called PMI, or private mortgage insurance. Homeowners who are unable to make a down payment of at least 20% of their home's purchase price are often required to buy this insurance. This insurance protects the lender in case of default on the loan. The tax deduction for mortgage insurance was extended through 2016 for mortgages taken out or refinanced after January the 1st, 2007. 2016 will more than likely be the final year for this particular deduction. If adjusted gross income, or AGI, reaches or exceeds $109,000, $54,500 if married filing separately, the deduction is totally eliminated. Interest paid on money that's borrowed to buy investment property, such as stocks and bonds, can be deducted on line 14 of the Schedule A. We complete Form 4952, Investment Interest Expense Deduction, in order to claim this interest. We add lines 10 through 14. There's no limit here either, and this total amount of interest paid goes on to line 15. Next, we'll cover charitable gifts. The IRS allows taxpayers to deduct donations given to approved charity sponsors, church donations, Salvation Army, Goodwill, and so forth. The next section of Schedule A is where these gifts are detailed. On line 16, enter all the gifts by cash or check that are made to qualified charities. This includes contributions to religious groups, churches, synagogues, and mosques, nonprofit organizations, the Salvation Army, Red Cross, Goodwill Industries, United Way, to name a few, veterans associations, not-for-profit schools, and public park and recreational facilities. If a gift was $250 or more, the taxpayer must have a receipt from the recipient. Gifts of property are reported on line 17 of Schedule A. On this line, we enter the value of the used clothing, household goods, or vehicles that were donated. Keep itemized lists of what was donated and its fair market value. The definition of fair market value: the price at which the property would change hands between a willing buyer and a willing seller. Keep these itemized lists for records of proof. If the amount of any single non-cash contribution is greater than $500, then Form 8283, non-cash charitable contributions, must be completed and attached to the Schedule A and to the tax return. And if the deduction is more than $5,000, the IRS may require appraisals of the donated property. Travel costs to do charitable work can also be deducted, as well as out-of-pocket expenses related to a charitable endeavor, such as stamps for a group's mailing. These amounts would also be included on line 17 of the Schedule A. There are some contribution outer limits. Annual cash contributions cannot exceed 50% of adjusted gross income. Annual gifts of property, such as stocks, bonds, and artwork, cannot exceed 30% of adjusted gross income. If more than the outer limits are donated, the taxpayer can carry over the non-deductible amount. The taxpayer has 5 years to deduct it on future tax returns. If there is a carryover from last tax year, enter the allowable amount again within the percentage guidelines on line 18 of the Schedule A. We add lines 16 through 18 in the Gifts to Charity section of Schedule A. This amount represents the deductible gifts to charity and is totaled on line 19. Next, we'll move on to casualty and theft losses, Schedule A, line 20. Now, there's never anything good when a person is the victim of a casualty or theft. The IRS understands this and allows taxpayers to recover some of their losses at tax filing time. Most taxpayers think they can deduct casualty losses only if they suffer catastrophic damages. It's true that those victims do get some special tax options. But taxpayers don't have to live through a fire, a flood, a hurricane, a tornado, earthquake, or other catastrophe to file a casualty deduction. Losses from theft and vandalism are eligible losses, as are damages from an automobile accident, as long as it wasn't the result of driver negligence. Casualty and theft losses are reported on Form 4684. However, taxpayers don't get to deduct the full amount of an unexpected loss. We complete Form 4684 to determine how much can be entered on line 20 of the Schedule A. Form 4684 first reduces the loss by $100 and then by 10% of the adjusted gross income on the return. Next, we'll move on to job and miscellaneous deductions. The next section of Schedule A takes into account money that's spent in connection with a job, as well as a variety of miscellaneous expenses. This catch-all section has a threshold that taxpayers have to meet before these expenses can be deducted. The total expenses must exceed 2% of adjusted gross income. For a taxpayer making $40,000, that would mean that these expenses must go over $800 before they can be deducted. On line 21 of Schedule A, enter the total of all job-related expenses for which there was no reimbursement. Some of the deductible items are professional memberships, journal subscriptions, uniforms and the cost of keeping them clean, expenses of looking for another job in the same field. We file Form 2106, Employee Business Expenses, if any travel, transportation, meal, or entertainment expenses are claimed. Form 2106 then transfers to line 21 of the Schedule A. Even the IRS realizes how complicated tax filing can be, so it allows payments to a tax preparer as a miscellaneous deduction. The cost of tax preparation software programs and any fee paid for electronic filing can also be deducted. These amounts go on line 22 of Schedule A. Taxpayers can deduct certain other expenses as miscellaneous itemized deductions that are subject to the 2% of adjusted gross income limit. On Schedule A, line 23, deduct expenses that are paid to produce or collect income that must be included in your gross income. Hobby expenses, but generally not more than hobby income. Safe deposit box rental. Repayments of Social Security benefits. Legal fees that are related to producing or collecting taxable income or getting tax advice. Add all work-related and miscellaneous expenses shown on lines 21 through 23. Enter the total on line 24 of the Schedule A. Next, we calculate if there is indeed enough to deduct. On line 25, we enter the AGI from line 38 of the 1040. We multiply that income by 2% and enter the result on line 26. This is the threshold that expenses must exceed. Subtract this line 26 percentage from line 24's total expenses and enter the difference on line 27. This is the allowable deduction amount. If the 2% of AGI threshold amount is larger than the total expenses, then unfortunately there's no deduction. We enter 0 on line 27 of Schedule A. The expenses we detailed on the previous lines were limited by 2% of adjusted gross income, but the IRS removes that restriction on expenses in 7 specific areas. One of the most common deductions listed here by individual taxpayers is gambling losses. We enter gambling losses on line 28 of the Schedule A. Remember that while gambling losses aren't restricted by a percentage of income, they are limited by good luck. Deduct gambling losses only up to the amount that was won. That is, if the taxpayer won $1,000 and had losses of $1,700, then he or she can only deduct $1,000. And don't forget to include any winnings on line 21 of the 1040 as income. Other miscellaneous deductions allowed on line 28 include casualty and theft losses from income-producing property, federal estate tax on certain inherited income, amortizable bond premium on certain bonds, the deduction for repayment of amounts under a claim of right, and certain unrecovered investment in a pension, and impairment-related work expenses of a disabled person. For more details, consult IRS Publication 529, Miscellaneous Deductions. So we add the amounts on lines 4, which is your medical, 9, which are the taxes, 15, the total interest, 19, charitable deduction, 20, casualty and theft losses, 27, job and miscellaneous deductions, and 28, other miscellaneous deductions. We enter the total on line 29 of the Schedule A. Then we carry this amount to line 40 of the Form 1040. If the total itemized deductions on line 40 of the Form 1040 exceeds the standard deduction amount for the taxpayer's filing status, then it will benefit the taxpayer to itemize his or her deductions and file Schedule A. In summary, some taxpayers cannot take the standard deduction and must itemize. One example of this is if the filing status is married filing separately and one spouse has already filed his or her return and itemized on the return. Examples of types of expenses that indicate looking at itemized deductions on the tax return are large out-of-pocket medical and dental expenses, state and local income taxes, sales tax, real estate taxes, and/or personal property taxes, mortgage interest, gifts to charity, casualty, theft, and certain other miscellaneous deductions. Next, let's take a look at a few review questions.